Assalamu alaikum friends, welcome to lecture 7 of SBR, and today's topic is IAS 10 events after the reporting period, a very short and sweet lecture. So let's start. Here we are going to focus on two things. One, which is known as adjusting event, the other one is known as non-adjusting event. And how do you deal with it? So events after the reporting period, okay? That means those events which occurs between the reporting date and the date on which financial statements are authorized for issue. There is a difference. Okay, there's a gap. So during that gap, any event that occurs, that is known as events after the reporting period. But some needs to be adjusted, some you do not adjust, and you have to identify which ones. We are going to go through that list. But there are two types of event. One is adjusting, the other one is non-adjusting event. And financial statements are prepared on the basis of condition which existed at the reporting date. Okay. So now we are going to go through this, and you already need this for IAS 10. You understood this, you understood IAS 10. So events after the reporting period, okay, that means events that occurred after the year end, but before the financial statements are approved. Two events, adjusting and non-adjusting, okay. Conditions which existed at the year end. If you have any evidence that says that this condition existed at the year end, they are known as adjusting event. You have to adjust the financial statement. But there are those which do not exist at the year end. It happens after it, but condition do not exist at the year end. I mean, looking at the year end, you cannot say these things will happen. They can also need to be adjusted financial statements if it can impact your going concern assumption. Remember, sometimes, okay, conditions which do not exist at the year end, but if it impacts your going concern, if it can impact your going concern assumption, you have to adjust the financial statement. But what if it does not impact your going concern assumption? Then you do not adjust financial statement. But it does not mean you just wait like this. No, you have to disclose it. Even if you're not adjusting it, you have to disclose what? Disclose the nature of the event and the impact of the financial effect. What is the financial effect? Estimate of it. These two things you have to disclose. Let me repeat again. If it is an adjusting event, adjust the financial statements. If it is non-adjusting event, but it impacts the going concern, you adjust the financial statements. If it do not impact the going concern, disclose the nature and the effect of financial effect. That's it. That's it. IAS 10 is all about that. Now your job is to identify whether it's an adjusting or a non-adjusting event. Adjusting event are examples like this. I have given you some examples for you to help. For example, you are selling an inventory after the reporting date. It's an adjusting event. Why? Because it gives the evidence about the net realizable value at the reporting date. Don't you have the evidence? What is the net realizable value of the inventory at the reporting date regarding inventory? So if you are selling that inventory after the reporting date also, it's an adjusting event because you have the evidence at the reporting date. Second, bankruptcy of a customer after the reporting date. That's an adjusting event. Why? Because it confirms that an allowance is required against a receivable balance at the reporting date, isn't it? Third, any discovery of fraud and error, it's an adjusting event because that means your financial statements are incorrect. It can have a material impact. That means your going concern assumption, it can have an impact. So adjust. Settlement after a reporting period, the court case. Definitely, because evidence is there for that court case. Suddenly court case will not happen, no? Suddenly settlement of court case will not happen, no? Obviously that court case was going during the financial reporting period also. So you know that court case is there. Obligation existed at the reporting date. That's why if any settlement happens after the reporting period, it is an adjusting event. Okay, so in your exam, look for these four conditions. Whether it's a recover, whether it's a fraud, whether it's a settlement after the court case, whether it's a bankruptcy of a customer, whether it's a settlement of inventory, is an adjusting event. Non-adjusting events are those events which you do not adjust but you disclose. Okay. For example, a major business combination after the reporting period or the disposal of a major subsidiary. Because at the reporting date, you do not know that you're going to sell the subsidiary. Maybe later you thought, okay, let's dispose the subsidiary. So at the reporting date, there is no evidence. So it's a non-adjusting event. Second, when you're planning to discontinue an operation after the reporting date. It's a non-adjusting. Do you have any evidence that you are going to discontinue the operation at the reporting period? No. Third, if you purchase or dispose any asset after the reporting date, if there was some evidence that you are going to dispose, or you make some kind of announcement that you are going to dispose or purchase some asset at the reporting date, then it's an adjusting event. Otherwise, non-adjusting event. If any asset gets destroyed by a fire, it's non-adjusting. How do you know suddenly it will get destroyed by fire after the reporting date? You do not have any evidence, so it's a non-adjusting. If you are planning to do a major restructuring after the reporting date, non-adjusting. Large changes in the foreign exchange rate after the reporting date, non-adjusting. Because at the reporting date, how do you know foreign exchange will change or not after reporting date? You don't have any evidence. So non-adjusting event. And last but not the least, equity dividends that are declared after the reporting date, non-adjusting event. Okay, so you have to see. Not in the exam, always they will not give you adjusting event. Sometimes they will give you non-adjusting event also. And what students do, they are always in that mindset, they will give the adjusting event. So you go and adjust. Don't do that. Don't do that. Sometimes they will give you non-adjusting event also. So you have to tell that you have to disclose. Or you have to give the financial impact. They will give some figures also. Okay. Now let us summarize this. There is no question for this lecture. Okay. I mean, from the textbook there is no question, but revision kit does have questions. So please do it. We started with the adjusting event, saying adjust the financial statement. Okay. Adjusting events are those events for which there was an evidence at the reporting date that this event is going to take place. Second, you adjust the financial statement. Then non-adjusting events which do not have an evidence at the reporting date that conditions are going to exist. Right? If it impacts going concern assumption, adjust financial statements. If it do not impact, do not adjust but disclose the nature and the estimate of the financial effect of that event. Okay. Thank you for watching. See you in the next lecture, which is a big lecture. What is it? After IAS 10 is IAS 12, the income tax. So thank you for watching, and do not forget to subscribe my channel if you are watching my video for the first time. If you have not subscribed to my channel, please do subscribe so that you get the updates of all my latest videos.